Good evening. Welcome everyone to September Trends Plus webinar presented by CattleFax. My name is Matthew McQuaig. I'm a market analyst with CattleFax, and I'll be one of your speakers tonight. To start things off, we'll turn it over to Holden Ramey. As we go through this, though, if you have any questions at any point in time, feel free to type them into the chat box, and we'll have some time at the end of the presentation to go over those. With that, Holden, I'll turn it over to you.
Yeah, for sure, man. Thank you for that introduction. As you said, I'm another market analyst here on staff at CattleFax, going on about 4 years, and I'm going to cover the grain and feedstuffs conversation this evening. I'll also dive into a little bit of economic or macroeconomic overview, as well as talk a little bit about beef demand. So without further ado, we'll go ahead and jump into tonight's grain conversation, starting with kind of the drought monitor here. And you can see there's a pretty distinct line right there running along the Continental Divide. If you're west of that, it's still pretty dry, still pretty in rough shape from a precipitation standpoint. But as you work into a lot of those Central Plains states, they're in a lot better shape. I've seen a really pretty decent precipitation over the course of the summer. As you work kind of further there in the Midwest, some states are okay, but especially as you get into the Ohio River Valley there, Illinois, Indiana, Ohio, you do have some dry pockets through some of those areas as well. Now, from a cattle standpoint, obviously being dry in the West certainly isn't ideal, as there's plenty of cattle through many of those states. But from a crops and grain perspective, to see these Central Plains states and even some of these Midwest states in as good a shape as they are is certainly positive, and a lot of these crop condition indices reflect that. So rolling to the next slide there, Matt, we'll start tonight's conversation talking about corn. Kind of starting with the balance sheet here. This is current as of the September WASDE. You can see that in the third column from the right. That is the most recent WASDE here. You can see they did change acres just a little bit from the August WASDE. They raised both planted and harvest acres by about a million acres and some change. They did drop the yield, however. In the August WASDE, they had yield close to 189. This time they're a little closer to 187. I certainly think that makes sense. I know there was plenty of surprise around that August yield number. I think we're working back to a more realistic number here as we get the September yield, and even the September yield may be a little bit to the high side, and we'll get into reasons why here in just a moment. But ultimately, you're going to have a production number somewhere there in the neighborhood of 16.8 billion bushels, which is from a historical standpoint, pretty much a record crop. As we get into some of the usage categories there, you can see really no changes there, except for exports. Exports, they did raise by 100 million bushels. And again, we'll talk in just a moment why that was done. But ultimately, you're ending up with ending stocks there around 2.1 billion bushels. And an ending stocks to use ratio there right at 13.1%. And we'll put some perspective around that percentage here in just a moment. So again, just kind of showing some of those balance sheet line items from a historical standpoint, starting with planted acres. Again, with planted acres in there at 98.7 million acres, you can see from a historical standpoint that is the largest planted acres we've seen. The only year that comes close in there is 2012, when you were closer to that 96, 97 million acres. Looking down at yield there, again, you can see that generally yield does tend to trend higher over time. Certainly the exception of that is the years of 10, 11, and 12. But generally, we do continue to move higher over time. This year, you can see even with the September yield estimate at 186.7, that's a pretty big jump compared to previous years. And again, like I said, yes, weather conditions, especially precipitation, has been optimal across many of these corn growing areas. But no doubt there has been some challenges hearing, especially as we go into harvest here. There are some factors that may drop yield even a little bit further than that 186.7 estimate. But overall, I think the big picture is important to keep in mind here that it's going to be a sizable crop. Ultimately, with acres and yield, you ultimately get to that production number. And again, you're basically up there at 16.8 billion bushels. And you can see we're by far and away the largest, given current expectations, the largest corn production in history. There's only a handful of years that are even close. You have 23 at 15 billion bushels. You have 2016, that was a little north of 15 billion bushels. But again, just looking for a really sizable corn crop here this year, and an extremely big supply by the time it's all said and done here. Moving on to some of the demand side lines of the balance sheet, starting with feed residual there in the top chart, we are looking for a feed and residual number that's somewhere in the 6 billion bushels vicinity. And that is up from the 5.5 billion bushels that we saw in 2024. And again, relative to where we've been previously, you can see that it's very elevated. Now, certainly the thing that would lead you to kind of question this feed and residual number is the fact that, yes, we do have less cattle on feed than we do a year ago. Most recent on-feed report had on-feed inventories down about 1%, and they've kind of been running 1% to a couple percent below a year ago now for much of the summer so far. But again, we continue to feed those cattle for longer and longer days using more and more feed. So I do believe that's what's being factored into this elevated corn usage level for feed. Now, certainly, it still may be a little bit overstated at this point, but that's what we're working with at this point. Ethanol production, starting with 2024, the crop year that we just wrapped up here, you can see that red line above the blue line of 2023 for basically the entire year. Ultimately, when all was said and done for the last crop year, we were 180 million gallons larger in 2024 than we were in 2023. Stout ethanol production, mostly due to reduced corn values. Here in 2025, we are starting off the year pretty elevated from an ethanol standpoint, even though we only have a couple of data points. You can see we are above the red line, but we're also still well above both that 5 and 10-year average, already up 9 million gallons so far, even just having 2 weeks in the books at this point. Exports, starting with the upper right-hand corner of the annual chart, you can see in 24, 25, again, that's the crop year that we just finished up. We did export somewhere in the neighborhood of 2.8 billion bushels, which historically, again, is one of the biggest numbers that we have. And you can see that in both the left-hand charts, the top one being the outstanding sales of corn to the world. Basically, that's corn to be shipped. And then the bottom chart is U.S. corn exports to the world. That is corn that has already been shipped. And in both of those charts, you can see the red line consistently on top of the blue line. Last year overall was a really solid year from an export standpoint, and that can be attributed to the softer corn prices that we saw for much of the year, as well as just a cheaper U.S. dollar, making our domestic corn of value on the world market. That's really what drove exports for a bulk of the year. As we look towards 2025 and 2026, this crop that we're just now starting to put in the bin here over the last couple of weeks, we are expecting a corn export number there, another record large year, around 3 billion bushels. You can see that again in that upper right-hand chart. And then the black dots here on the two left-hand charts, that's just the first week of data that we've had. And again, you can see we're already starting out at pretty stout levels on both outstanding sales as well as the weekly corn export data. So this shows the current crop again, and the one that we're just kind of starting to harvest in a lot of these areas. The top chart shows the crop condition index, and again, you can see it is kind of trending lower here as it typically does this time of year. But you can see we're elevated. There is a lot of years underneath where we currently are, and no doubt that's a testament to how solid the crop's been throughout basically this entire growing season. There's only a handful of years when the crop was in better shape at this point on a U.S. average basis, of course. That bottom chart kind of breaks it out on a regional basis. And again, you can see a lot of these western corn growing areas, as well as in parts of the Midwest. A lot of those areas, the crop condition index is well above the 5-year average. However, you can see there, Illinois, Indiana, Ohio, they are running a touch behind the 5-year average, as well as Michigan. And again, that can just be attributed to what we showed y'all on the drought monitor. Just some pockets of dryness in those areas, kind of slowing the crop up a little bit. But again, big picture on the corn crop, it's going to be a pretty sizable supply by the time it's all said and done here. So again, as I told you on the balance sheet, with stocks to use expected to be there around 13%, this chart kind of puts that into perspective for you. The bars, the height of the bars show the expected stocks to use ratio on a monthly average basis. And the red is the spot futures price. So you can see basically there from 2015 to 2020, stocks to use stayed pretty consistently on top of 10%. And ultimately, that was a pretty comfortable place for the market to be. Spot futures prices stayed pretty sideways there between $3 and $4. As you look from 20 to 23, that's when we started seeing stocks to use numbers dip back below 10%. And that obviously was much more of an uncomfortable place for the market to be. And that's ultimately what sent prices substantially higher during that time frame when we got corn up towards $6.50, almost $8. Here today, again, with that 13% stocks to use in mind, again, the corn market has been in a pretty comfortable place from a supply and a demand standpoint. You know, dang sure we have that record supply being met with record demand, but even so, the corn market's pretty comfortable where it's at. That's kind of led to prices kind of moderating here throughout much of 2025, but they do seem to have stabilized here over the last month or so. And we'll talk more about prices here on the next slide. The top chart, December corn futures, here over the last couple of years, you can see that very prevalent downtrend here over time. Again, as I said, I do think the low that we made there a couple weeks ago in August, I think that's going to be a pretty significant low for us. I think we kind of marked out the bottom end of the range there here for a little bit. Have seen a little bit of an uptrend get going here as we've gone throughout the balance of August and so far here in September, despite getting a little choppy here over the last week. I do think ultimately we do continue to kind of see this uptrend take place. I do think there's upside potential for the corn market up towards 450, especially as we go throughout the balance of this year and get deeper into the harvest season. That bottom chart shows spot corn futures. Basically, that's the second half low to next year's first half high. Again, that second half low that we put in there in August was 372. And I know that comment says so far, but again, in my opinion, I do think that's ultimately going to be the low in spot futures here for the second half. You can see that the 10-year average rally off of that low to the next year's first half high is about 40%. Well, given what we have from a supply situation, as well as the stocks to use where we currently sit, I guess in my opinion, I'm expecting a bit smaller than average rally this year. So I kind of chalked the field for you up there. If you take 20% of 372, get you back kind of that more mid $4 range. If you run a 30% rally, you can get up to the upper $4 range, and then obviously if you get the full 40, you're getting well on top of $5 at that point. At this point, given where May 2025 corn is currently trading, the market's already pricing in a 20% rally. So I do think that's a good baseline expectation for us, and ultimately I do think 30% is a realistic expectation. Ultimately, I do think we'll get corn up there into the upper $4 range come next late winter, early spring. Kind of rounding out our corn conversation here with spot corn futures, just kind of taking a bigger picture look at it. Again, this year we are expecting to average higher by the time it's all said and done, around 435. That's up from 424 last year. As we look towards next year, again, we're expecting to average higher yet, up towards 448, and ultimately trading the full range between basically $4 and $5 as a practical range for the bulk of the year next year. As we switch gears here over to the soybeans, again, starting with kind of the balance sheet here, you can see that both planted and harvested acres, they're kind of around 80 million acres. You can see the year-over-year change there. We did drop acres, about 6 million acres, respectively. A lot of that due to the fact that a lot of those acres that typically are shared between corn and soybeans went to corn this year. Yield from a soybean standpoint is going to be there around 53.5 bushels an acre. That is a 3 bushel per acre increase over last year. Even despite this, the increase in yield, it's not able to overcome the drop in acres, so you do end up with a production number there around 4.3 billion bushels, which is around 65 million bushels smaller than a year ago. As you look down through a bunch of the usage lines there, you can see where we're kind of running above a year ago levels, with the exception of exports. Exports of 1.6 billion bushels, that's a drop of 190 million bushels from a year ago. And a lot of that can be attributed to the fact that, one, yes, we're going to have a tighter supply of soybeans with smaller planted and harvested acres. But we're also still haven't seen much out of a Chinese trade deal here at this point. And obviously, I mean, prior to this point, typically we don't ship a whole lot of beans to China through a lot of the summer months, but certainly as we get into harvesting beans here, we do see typically exports start to pick up. So if we don't have a trade deal there on the soybean side, especially, that'll no doubt start to impact the market here right in front of us. Again, you're getting an ending stocks number that's around 300 million bushels, and that leaves a stocks to use ratio around 7%. And again, just like we did on the corn side, we'll provide some perspective as to what that means here in just a minute. Again, showing some historicals to the balance sheet numbers, again, on the production side, with production on top of 4 billion bushels. You can see from a historical standpoint, that's not necessarily overly small, especially as you look back there towards the early 2000s. You're kind of right in line with where we've been here recently. But again, with having those few less acres and some of those acres that are typically shared with corn go planted to corn, you do see production just a little bit smaller here this year. Soybean crushings there on the bottom chart, again, ran pretty consistently there from 1.7 to 1.8 billion bushels from basically 05 to the 13-14 crop year. But then after that, obviously with the demand of soybean oil, especially for renewable fuels picked up, you've seen soybean crushings basically increase each and every year since then. And this year definitely isn't any different, expecting to crush somewhere between 2.5 and 2.6 billion bushels of beans, which is up from 2.4 billion bushels last year. Again, on this chart, same as the corn, the height of the bars represents the stocks to use, and the red line tells you what the monthly average spot futures price was for that month. So again, if you look back there, basically from 2015 to 2020, you had stocks to use. So we're pretty consistently on top of 8%, and mostly on top of 10% as well. So that kept the soybean market pretty well in check, both basically there between $8 and $12. But again, post 2020, basically until 2024, you got some pretty stocks to use levels, got pretty tight stocks to use levels, pulling back there sub 6%. Again, that was a pretty uncomfortable place for the soybean market to be, and ultimately that's what sent prices substantially higher during that time frame. Today, with where we sit on soybean stocks to use around 7%, we're kind of right on that borderline. Obviously, the market's not overly concerned about it today, especially with the lack of a Chinese trade deal. However, if you were to tighten the crop up in any way, shape, or form, or if something were to come out about a trade deal being done, that would obviously be extremely supportive of the soybean market and probably send prices back, up towards that $12 range. Switching over to hay here. Again, as we look at May 1 hay stocks here in 2025, we've got about 24 million tons, or had about 24 million tons during that time frame. That's up from the 20 million tons that are in 2024. No doubt, a solid spring through a lot of the central plain states allowed for pretty solid hay production. At the same time, having less cows than we did a year ago has moderated demand for hay, so that helped add to stocks as well. Looking at the bottom chart, that's hay production. This year we're looking at about 120 million tons, which is basically in line with where we were last year. You can see, yes, from a historical standpoint, it is tight. But at the same time, hay production does trend lower over time, as does the cow herd. So it kind of lines up with that. 2022, that's an important year to keep in mind in the hay market. We pulled production back towards 110 million tons, and again, we'll show you the price chart here in just a second. That was an extremely tight supply, even given the cow herd that we had. So that's ultimately what sent prices higher during that time frame. Again, kind of regional hay prices here. Again, you can see what that tight supply did in 2022 and 2023. We definitely got into an elevated price environment here today with bigger supplies and certainly a smaller cow herd than we had back in 22 and 23. Prices have settled back to basically where they were in 2020, pre the big rally. U.S. average prices there in the black, kind of running between $150 and $175 a ton. Both the west and southeast prices still kind of running $175 to $200 a ton, and then the green line showing the north obviously has the advantage from a hay price standpoint, kind of running $100 $125 a ton in that vicinity. On the next slide, if you can see that we ran alfalfa prices here in the black against spot corn futures there in the red, and you can see they're pretty correlated with one another. And again, that's primarily driven off the weather. Again, if you have drier weather, obviously pulls the supply of both hay and corn lower, and ultimately sends prices higher as they work to ration that tighter supply. And certainly that's what you saw from 21 to 23. Today, both have kind of moderated back down, as we're looking at pretty solid supply levels. But again, something to pay attention to, especially if that drought does start to spread east of the Continental Divide. Matt will talk some of the extended range forecast here in just a minute. But if we start to see pockets of dryness expand, obviously that would send some of these feed prices substantially higher if we were to pull the supply back lower. Kind of round out our grains and feedstuff conversation here, looking at pasture land. Again, northern plains, southern plains, as well as areas of the northwest have crop or pasture conditions that are above the 5-year average. However, as you look at the Southwest on into the parts of the Northeast and Southeast, they are trailing behind the 5-year average just a touch. Again, just have some dry areas through those regions. Look at the economic landscape here, especially from a macro standpoint, starting with inflation and interest rates. Again, looking at inflation, obviously it got out of hand there with all the pandemic relief dollars. You can see the consumer price index got on top of 8% there as consumers had more money in their pocket and not enough goods to purchase. So ultimately everything got more expensive. You can see today, inflation has certainly settled back down, kind of running in that 2 to 3% range. But no doubt, to me, the most important thing on this slide kind of is that third line in that text box that since January 2020, inflation still remains up 26% from a year ago. So everything, food, fuel, things consumers buy every day, still remain more expensive. And no doubt that's why the consumer continues to feel squeezed today. Interest rates there in the blue. This says August of 2025, 7.5%. Obviously, here last week we did get another rate cut. Prime interest rates are still running around 7.25%. So even so, you're still really elevated from a historical standpoint. Does sound like we'll see subsequent rate cuts here in future months. But again, that is no doubt certainly impacting the cattle industry in a lot of ways. And as Matt will talk about here shortly, the herd expansion is one of the ways that this elevated interest rate impacts the cattle business. Unemployment rate continues to chop pretty sideways there, around 4%. No doubt, in my mind, this is one of the major reasons that the U.S. economy has been able to avoid a recession. Certainly here over the last 2, 3, 4 years, you've heard a lot about impending recessions or looming recessions, what have you. Certainly plenty of talk about that. But again, this is, in my opinion, one of the ways we've been able to avoid that. Yes, the consumer feels squeezed. Yes, everything they buy is more expensive. Certainly they're racking up credit card debt, but at the end of the day, they're still paying bills. They're still making payments on their debt because they're still working. Obviously, if we were to see this start to tick up a little bit, that would certainly be concerning from not only an economic standpoint, but also a beef demand standpoint as well. If you saw this start to tick up, that would kind of send a caution flag, especially given the elevated retail prices we're currently seeing. Sticking with that macro view here, looking at personal savings there on the top chart and consumer spending there on the bottom. Obviously, with those pandemic relief dollars, a lot of consumers put those away and put them in their personal savings accounts. You can see those spikes up there in personal savings. Obviously, today, inflation and increased spending has deteriorated consumer savings fairly rapidly. Today, we're sitting only about $1 billion in people's personal savings account, which basically is where we were pre-pandemic. You can see it's mostly a sideways trend. Certainly with the consumer being squeezed, you're not seeing it tick up any at this point, just because they are having to spend so much to keep up with their purchases. And no doubt you can see that below in the personal expenditures for basically 05 to 20. Yeah, we ticked up over time, but you can see the rate of change was a lot slower than what it's been here as late. Inflation, no doubt, making that curve quite a bit steeper from 2020 on. To the point today where we're basically around $21 billion from a consumer spending standpoint. So no doubt, just further highlighting that the consumer does continue to be squeezed. S&P 500, looking at a weekly chart here. Again, we're still in this big uptrend, have been for the better part of 5 years, 6 years now. Obviously here as of late, it kind of makes a new high each and every week, and honestly, these days that's kind of become the expectation. But as we all know, what goes up eventually will come down or have a pullback at some point. So that's certainly something we in the cattle business will want to pay attention to here going forward. It certainly does impact our business. If the stock market's going up, people's retirements are doing well. They feel like they have money to spend. They're certainly more likely to spend money on elevated retail beef prices. However, vice versa, if income or if the stock market's going down, people feel like they're closer to broke, retirement's not doing very good, they feel like they got to rein in their spending. Obviously, that would be a headwind for these elevated beef prices. Speaking of retail beef prices, here in September, we did get the August price there around $9.18. You can see that's a pretty stout jump from where we were in July at $8.90. Those two dotted lines out front of us there, those are our forecasts. So ultimately, we do expect the retail beef price to continue to climb as the market continues to work to ration the tighter supply that we continue to see. That bottom chart, again, that 918 is dang near 13% above a year ago. And no doubt we continue to outpace our competing proteins. Pork was only 2% above a year ago. Likewise, broilers were just under 2% above a year ago. So certainly that is a little bit of a caution flag. We are outpacing our competitors substantially. Has it been a problem or a headwind to this point? Certainly not. I mean, prices just continue to move higher on the beef side. But certainly it is something to continue to be cognizant of and pay attention to here as we go forward. I like talking this chart starting with 2024. You can see that demand index there that year was around 140. And 2024 to me was a really significant demand year. As Matt will talk about here in just a second, you ended up with really larger beef production, but you were still able to sustain the higher prices. And you can see as we go here in 25 and 2026, we're even better than where we were in 2024. So no doubt seeing extremely stout demand with a demand index running there around 150. Again, we have a consumer that still goes to the meat counter and still demands beef. That's certainly positive for our business as we need those retail dollars to keep flowing into the system to support the higher fed prices, feeder and calf prices all the way up the supply chain. You can see retail beef prices there in that blue line. We were 801 in 24. We're up here expecting to average around 880 in 2025. And then as we look towards 2026, we'll average even higher yet there in the vicinity of 920. To me, on that demand conversation that we just had about how the consumer continues to chase our product, even though it does cost them more. To me, this is where the rubber meets the road. This is how we've been able to grow that demand. From 2000 to 2008, only about 55% of cattle were grading choice and higher. We've been able to grow that today, from then to today. Better animal genetics, better animal feeding, better animal husbandry, all of the above. We've been able to expand this grading percentage to today. On top of 80% of cattle are grading prime and choice, and are over 10% of those cattle are meeting that prime grade. So no doubt this is significant. This is a testament to what y'all are doing in the industry. This has been important in allowing us to achieve these current price levels that we're seeing. And to kind of round out my side of my end of tonight's talk, looking at the food service demand, the restaurant performance index there in the red. You can see if you're above 100, that's typically expansion or positive food service growth. Whereas below 100, that's contraction, that's negative food service, people eating out less, being more defensive in their spending. You can see here in 2024, early on, we were in that contraction level. Late in 24 and early 25, we got back into that expansion range. kind of dipped back down for a minute here in 2025, but today we're basically par. So not necessarily expanding, but not terribly far behind either. Just kind of in kind of that middle ground right now. So certainly not overly negative. The bottom chart, shows the expectation index there in the blue. The green line is the same as the red line in the above chart. So the blue lines, what we're going to focus on here, basically that's what food service individuals think is going to happen going forward. And you can see it's pretty much the same, moves pretty much the same as the current situation. Similar kind of pattern here, late 24, 25. They were fairly positive. Earlier this year, they were just a bit on the negative side, and today they're running about par. So again, not overly bullish, not overly bearish, just kind of some middle ground here as far as food service goes. So with that, I'll go ahead and turn it over to Matthew, and he'll walk you through some expectations on the calf supply, as well as look at some prices on down the road.
Thank you, Holden. So as we get started with the cattle cycle, I wanted to kind of briefly touch back to that weather discussion that Holden laid out for us. As he illustrated, really good precipitation this past summer, particularly in the south central United States and then up through the Corn Belt. But the western half, or west of the Continental Divide, is still really struggling. Then as we look ahead into winter, this is the official NOAA ENSO probabilities, and the bottom axis represents the months. So this would be August, September, October. And you can see as we go through the fall here, pretty strong odds of La Nina before shifting back into increased odds of a neutral weather pattern into that winter and early spring time period. And so what this means is typically a little bit warmer, drier winter in the South Plains. We do have potential for increased moisture in the Pacific Northwest. And so all in all, not a bad winter, likely be a little bit drier. But this follows a very wet spring and summer, which has really resulted in quite a bit of optimism in some of those South Central states in terms of rebuilding the herd. When we think about this relative to the overall U.S. beef cow herd, approximately 23% of the beef cow herd is in drought-affected areas, a little bit below the long-term average, but still not enough, still not low enough to suggest widespread expansion across the entire United States. We'll see it a little bit more regional basis here moving through this fall and as we get into that decision-making process in terms of retaining heifers. So taking a step back and looking at the overall U.S. cattle inventory and total beef production across the last 75 years, you can see that U.S. cow herd or cattle numbers peaked in the mid-70s and have been trending fairly steadily lower ever since then. But at the same time, beef production has been able to not only maintain, but actually increase due to increases or improvements in some of the animal husbandry practices Holden was mentioning, better utilization of crossbreeding within the dairy industry, and then improvements in feeding technologies and techniques at the feedlot level. Focusing specifically on the cattle inventory, you can see the cyclical shape of the U.S. cow herd, where typically cattle numbers follow whatever the price market is doing. And so typically prices spend 5 to 6 years in a downtrend before spending 4 to 5 years in the uptrend. Currently, we're in year 5 of this current price uptrend. And so as we look at that and we start to think about what that means to cow inventory numbers, we need to start to think about how it, or when we get to that point where prices start to roll over. We'll talk a little bit about that throughout this presentation. Dialing into just the beef cow inventory numbers since 2000, a couple big things to pay attention to here. First off is just how much or how sharp of a decline followed by how rapid of an increase we saw in that previous cycle low in 2014, and how rapidly the cow herd expanded, leading to prices then overshooting the runway and then rapidly falling lower. This time it's going to be much slower of rebuild, much more of a U-shaped bottom, just because we have some of these other factors limiting the ability of the U.S. cow herd to expand. Chief among those has been that prolonged drought. Then we also have to recognize some of the other challenges, such as high interest rates and just the overall cost of capital, the age of producer, and then just general uncertainty in the marketplace. There's a lot of moving factors right now and a lot of external forces going on with border shutdowns, tariffs on other countries, and then just other trade talks, all of which impact our market and create a little bit more volatility than we'd really like to see. So all this, again, much slower to rebuild this go around, and that should serve to keep the calf supply tight and better enable us to kind of maintain some of these higher trading ranges, even when we get to the point where we start to turn a little bit lower. So when we think about that beef cow herd, we start to think about the two levers that can drive the increase in the cow herd going forward. First off is that beef cow slaughter side of things, the cull cow side of things. You can see this year we're down 350,000 head year to date in terms of beef cow slaughter. We expect to end the year down around 400 to 500,000 head this year, with larger declines noted in the fourth quarter, even as we start to seasonally increase a little bit going into that fall culling period. If you look at that on a long-term basis, you can see how high cow slaughter was in that 2020 through 2023 time period, and then how much it's dropped off in the last couple of years. If we think about that applied to that January 1st number, we do expect to see us running around that 8.5, a little bit below 8.5 or below 8% level applied to that inventory number to give us a general or implied culling rate for the nation's cow herd. That's down from the past few years. Last year, 2024, was around 10%, that long-term average, so pretty close to the maintenance level. This suggests mild expansion, at least on the cow herd side of things, or the aged female side of things. Again, we can only push factors so much on this aspect, and so more significant expansion will have to come on the heifer side of things. As we look at that, so this is U.S. beef replacement heifers, so this is a combination of younger, freshly retained heifers, and then heifers designated to breed or to calve in this year. In 2026, we expect to see a decent increase, but nothing like what we saw in that previous cycle. If you'll remember, 2014 was that cow herd low, but we'd already been keeping heifers back for several years prior to then. And so we were already primed for a rapid expansion, and that's just not the case in this cycle. So another factor that'll keep this beef cow inventory rebuild a little bit slower, a little bit more of that U-shaped, to where we won't really start to see the effects of that until 2027 and 2028. So when we think about heifers, we think about what are some of the signals we're getting that supports that heifer retention is beginning to occur. We've got several different indicators we can look at. I'll start here on the top right-hand chart. This is heifers as a percentage of cattle on feed. And so we get this in the quarterly reports. So the previous reading with heifers was July 1st, and that was the 6th consecutive month of declines in terms of heifers as a percentage of cattle on feed. Now, this does seem large compared to some of the historical levels. Typically, it would have to get below that 37 to 38% range for us to suggest more retention, but just due to shifts in dynamics and more utilization of beef on dairy genetics, we've actually increased that overall percentage of heifers on feed. So it's a little bit tougher of a comparison looking back beyond, say, 2019, 2018, but we can still recognize just the trends in the 6 consecutive quarters of year-over-year declines in terms of heifers on feed. As we look at the heifer makeup in terms of U.S. feeder and calf sales, you can see we're running a couple percentage points below year-ago levels, closer to the long-term average, yes, but we have to remember that through the first half of the year, really first 8 months of the year, those are calves or heifers that were born in the previous year. As we get into this fourth quarter time period, this will be really important to watch to give us a better feel for how much heifer retention is occurring out of this year's calf crop. Then finally, we can compare the price discounts or the price spread between heifer and steer calves. This has been a long-term widening of this price spread. A lot of that's due to, as we increase outweights in the feed yard level, it just increases the disparity between feeding performance between these heifer and steer calves. But you can see it's actually come back up a little bit in the last couple of years, particularly in 2025 for some of these lighter weight animals. And again, this supports increased demand for some of these heifer calves. So when we look at all this, we talked about the domestic supply. We have to spend a minute talking about the situation south of the border in Mexico. As we all know, the border was shut down third week in November last year due to detection of New World screwworm. It was closed through December, reopened in February, was open for a few months. We brought in 225,000 head during that time period before New World screwworm was detected a little bit closer. Border shut down again, was reopened in July for approximately 3 days. That enabled us to get close to that 230,000 mark, and it's been shut down ever since then. Then this past Sunday, a report came out that screwworm was detected only 70 miles south of the U.S. border, and that reiterates just the importance of managing or properly managing the transport system within Mexico. That was an animal that the animal that had New World screwworm on it was actually transported recently from southern Mexico in areas with wider spread of that disease or of that pest. And so again, that really highlights the importance of how necessary it is to have better safeguards and management for transport of animals from South Mexico to North Mexico. And that also more strongly suggests that we're going to be pretty slow to reopen the border. For anyone who had possibly been thinking it would happen late this year, that's likely not the case anymore. Now we're thinking possibly beginning of the year, sometime within the first quarter, but at this stage, it's really hard to tell. We have no clear guidance on when some of these requests from the USDA will be met by the Mexican government and when we can get better cooperation and management of that pest. So this remains a huge unknown that just creates more uncertainty in the marketplace. If we look at that compared to the long-term average, typically we bring in 1.25 million head. That 230,000 head is well below that this year. So that creates a huge decline in the overall supply mix of steers and heifers available for slaughter. So if we think about that, recognizing that when these calves come across from Mexico, the vast majority of them, or at least 70%, are typically weigh between 450 and 700 pounds. And so a lot of them will actually go on grass for a while before entering the feeding system. So we create a little model, just kind of track where that supply hole is and when it really starts to occur between calves that go on grass and then animals that go straight into the feed yard. You can see we're getting pretty close to the edge. We'll have a little bit of a jump early in 2026 from some of those animals that came across early this year. But again, we're rapidly running out of Mexican origin slaughter cattle, and that really exacerbates the overall decline in U.S. fed steer and heifer slaughter. Looking at this year, we're expecting to be down around 1.25 million head this year, with a lot of the declines especially coming in the second half of the year. Looking into 2026, we expect to see another decline of 500,000 head. But this creates a huge hole in terms of just our overall beef supply. When we think about that domestic production, we are able to make up some of this decline in overall fed slaughter. We can make back up through increased days on feed and heavier carcass weights. You can see long-term average, we gained about 4 pounds per year in terms of cold carcass weights. Last year, we jumped up 27 pounds, and this year, we're going to be up closer to 22 pounds. We've been able to do that through just improved genetics and then better feeding technologies. When we think about that, what that means from a days on feed standpoint, this year we're going to be just under 200 days on feed for an average native steer. That's up 40 days from where we were at, say, in 2000. So again, increased technologies and increased days on feed have really helped us to make up some of this supply hole that we're currently facing. That being said, we're still going to be down quite a bit in terms of domestic beef production through these declines in both fed and non-fed slaughter. This year, we're looking at a decline of approximately 3.5%, 26.1 billion pounds of beef. So again, these increased weights, these increased days on feed are not enough to offset these overall declines in available slaughter. So the market's searching for additional supplies of beef. We cannot produce enough to meet our consumer demand. And so that's where beef imports have really come into play this past year, where we're up where we're expecting to finish the year up 15% from where we were at in 2024. Traditionally, a large part of these, or the bulk of these imports come from Australia and New Zealand. This past year, we saw a large amount come from Brazil, particularly in the first few months of the year, record levels from Brazil. But that has since been negated and ceased through increased tariffs on Brazil. And so that'll be really important to watch. If that tariff continues, we're not going to be able to, or it's going to be very tough for us to sustain such high import levels. And there is potential for that to drop off next year, depending on what happens with those trade talks. On the export side of things, 10% decline in exports this year. A bulk of that is just from being shut out of the Chinese market as they have launched their safeguard investigation for their domestic producers. So that has been a little bit of a challenge or a little bit of limitation to prices, but at the same time, it came at a point when fed slaughter mixes already substantially declined. And so the market has really been able to actually shrug that off for the most part. This leaves us with an overall per capita net beef supplies mostly steady this year with where we were at last year in 2024. As we think about this overall supplies, we're running right at 58, 59 pounds per person. And a big chunk of that is in the form of ground beef. As we've increased these prices, we've seen quite a bit of trade down within the beef complex to more customers, more consumers switching to that ground product. We think about just how much we're importing, almost 5.5 billion pounds this year, and compare that to the overall domestic supply or domestic production. Over a third of our ground beef that we're currently consuming is mostly in the form or mostly from a foreign source. And that has really enabled us to meet some of this demand that consumers have by being able to put additional beef on the plate for them. So as we take that, we'll start to look forward into the overall or into the cattle market looking ahead. And we'll start with cattle on feed. We had a report last week, and there were a few key takeaways from this. Cattle on feed numbers did tighten back up a little bit in September 1st, down just 1% from a year ago, as we start to see more cattle come off the summer grazing. We'll expect to see cattle on feed numbers seasonally tick higher as we go into that fourth quarter. But a couple other takeaways. First off, is just how much, or is that placements have continued to outpace marketings as we've been extending the feeding period and adding days on feed to these animals. So that's come up quite a bit. And then as we think about that relative to our implied place against supplies, you can see how it's really starting to turn lower, again, through decreases in our domestic calf crops and then declines in imports of live animals. Going into 2026, very small place against supplies in terms of fed slaughter. If we think about this cattle on feed metric from a regional standpoint, Texas is going to continue to lead this supply decline going forward, and that's followed by Colorado, actually. When we look at our other regions, Nebraska is currently running above year-ago levels, so is Kansas. But as we look ahead at this implied place against metric, by February, all these major feeding regions are going to be running below year-ago levels in terms of place against fed slaughter. So again, we'll have a huge hole in the first half of next year that the market will have to deal with. As we think about that applied to fed steer prices, last week we were right at $238 on a U.S. average. We do think that after a few weeks, maybe a month of stabilization or mostly choppy movement patterns, we do think we'll pick back up going into the fourth quarter as we enter that holiday rib demand period. And right now we're targeting 250 or reaching 250 on a U.S. average sometime within that fourth quarter. Now, as we think about that relative to when that Mexican border reopens, again, we have no idea when that's actually going to happen. But if we start to think that maybe at sometime in that first quarter of next year, the market will start to anticipate that increased supply further down the line of when those calves go through the feeding system and are available for slaughter. And so there is potential that we will not be able to reach this 250 price again next year if we reopen the border fairly early on in the year. That being said, if the border stays shut longer, then there's very good odds that we'll hit that mark again sometime in that spring, early summer period. That being said, we are currently forecasting annual averages that are higher next year, just maybe not quite as extreme at the top side. So as we move up the supply chain, this was from the July cattle inventory report. Nothing major here, just how, except for the fact that outside supplies continue to decrease, continue to decline. Excuse us, that should actually be red. But again, outside supplies are down from 2024, very tight feeder and calf supply. When we think about how the feeder index has responded, again, very stout, very sharp increases throughout the year. And actually, you can see where the border shut down. There in May, we saw rapid growth. It reopened in July, shut down again here, and has continued to outperform. You can see these gold dots represent deferred feeder cattle contracts. Feeder cattle index is very well supported at current price levels going into early 2026. So we will not expect to see a sharp or as seasonal of a decline here in the fourth quarter this year. We expect to be a little bit flatter through the remainder of the year, giving us a larger starting point going into 2026. Thinking about stocker grazing cattle, right now for this winter, we do still anticipate that feeding cattle feeding stockers through the winter to be a profitable venture. Right now, about $140 per head in this model, with a 65-cent per pound of gain. This is down from 85 cents last year, 90 cents from the year before. But that being said, it's not quite as high as the last few years, and there's a little bit more volatility with it. So this might be a little bit of a better year to consider some risk management options with it. But just these high prices should continue to be supported, particularly by the cheap cost of gain. So we think about calf prices going into the fall, we'll see a little bit of a fall break, but not to the extent that we do normally. Again, similar to the feeder cattle, you can see how the market continued to push higher once the border was shut down again. This fall, we're looking at support right around $4. And that'll give us a better starting point next year. Right now, we're expected to average next year around $15 per hundredweight higher than where we're at this year. Looking back at this past summer, again, you can kind of see the overall trend, the seasonal trend higher in the summer video auction prices. We averaged 35% above year-ago levels. And one of the interesting trends was that we saw quite a bit of earlier marketings this year in terms of just producers trying to capture some of these higher prices and actually create a little bit of a supply hole in terms of these calves later in the season. Even though they were forward marketed, there just wasn't as many later in the season, and that translated to higher prices that also supported the U.S. average price. Looking at utility cow prices, this year, utility cows continue to perform very well. Right now, we're looking at around a 15% decline in the fourth quarter, not quite as much as the typical 20%. Pretty strong support in that 140 to 150 range. And that, again, will give us a pretty good starting point going into the next year. And if we continue to keep these high tariffs on Brazil, there's a very good chance that we'll reach 180 for utility cow next year. So again, very extreme levels, just not enough there to meet the demand for trim prices. And that's not going to stop, at least within the next couple of years. Looking at cull cows, for retained ownership through the winter feeding period to be sold in February. This is actually last year's chart, and you can see we averaged around $175 per head profit. This year we're looking at closer to $200 per head. Again, as costs for that pound of gain are a little bit lower this year, but these such high prices have made it a very attractive option for producers, particularly that are struggling to find some calves or feeder cattle to turn out on their winter grazing. Finding some cull cows that you can add a little bit of weight to is a very attractive option. Looking at bred female prices, I'll actually jump ahead to the next chart. This year, this winter, we're looking at bred cows averaging around 4,100 per head, with bred heifers around $4,200 per head in this winter to calve in the spring. As we look ahead into 2026 and 2027, so not this winter but next winter, we think the market will be another $300-400 above that. So again, very strong demand for some of these breeding females. And as we think about that relative to, say, retaining heifers out of this year's calf crop, actually, even at these high prices, it still is a good deal to be able to capture some of these higher values for the calves before the market potentially starts to turn a little bit lower, perhaps in, say, 2027. As we look at that overall break-even analysis, this is the year of the first calf, and you can see that a bred female purchased in late 2025 to calve in 2026, according to our data or our projections right now, will take around 3.7, so 4 calves before she pays for herself, before she breaks even, and back below the long-term average of 4.5. So for calves retained out of this year's calf crop to breed next year and calve in 2027, it's back to that long-term average. So again, even at these hybrid female prices, that suggests that if you can do something to get some more bred females around you, or you just have some additional heifers to market, it's still a very good opportunity. And as we get further into this uptrending market, just the benefit of it starts to decrease a little bit. So in conclusion, you can see again, we're predicting higher prices in 2026 with potential to start to decline in 2027. But a few key notes, as we get to the top of this cycle, prices will likely not be as impulsively higher unless we continue to see that southern border closed for an extended period of time. But again, these tight supplies, just how slow the U.S. cow herd has been to keep back some heifers and start to regrow our domestic supply, that should enable us to maintain a higher range for a longer period of time. So with that, we'll turn to any questions. With that, I want to thank everyone who showed up and sat through the presentation. We'll be back in January with our next Trends Plus webinar. There will be a link to sign up emailed to you in the follow-up email for this. Again, thank you so much to everyone who joined, and have a great evening.